if you don't invest, make proper investments, that wealth tends to reduce because every year they have to pay zakat. So growing wealth in a halal way, investing and growing and taking it to the next level has been encouraged by Islam. So there is no doubt about that. But again, definitely certain limitations and certain guidelines also have been given. Generally, if you see uh, as a general person, these are the financial investment options what we have in the market. Any person can invest into commodities, that is gold, silver, for example, precious metals. Then we have saving accounts, we have fixed deposits. Then we also have treasury bills and bonds. Real estate investments are there. Investment into mutual funds, different types of funds are there. Then investment into equity market, what we will be discussing in detail, and the ETF, exchange rate funds as well. And there can be some other investment options people can have on a one-to-one basis, on a structured basis, on a collective basis as well. So before we start the thing, these are few news items which has been there for some time. Uh, we see one item says CSE becomes the fourth best performing stock. That is in October. Today we have done much better than what we were in October. Then we have a very famous Expo Lanka story, which we'll be discussing in the coming slides. Then again, the market also falls after some time. During 2022-23, the market took a huge dip, a nosedive, and the loss was around 245 billion on this particular date. Then another news item says that Sri Lanka's John Keels has uh, signed up with the international gaming operator. Then LMD has given their top 20 companies. So these are different news items I just want to bring into your attention. So after we do the presentation, we see how, as a Muslim investor, what are the basic things which we need to look into before our investments are taken place. Okay. Stock market, as we know there are different markets. We say that there can be general markets. So stock market is a place where shares are publicly traded, right? So this is, as a definition, that's what happens. But for an economy, what happens is when a stock market grows, when there are activities takes place in a heavy manner, definitely there is a capital investors would come in. There is more confidence built in, and we know demand and supply is the main factor which decide the prices of each and every share. Other than that, there can be other factors. There can be good factors, bad factors, feel good factors. Now Sri Lanka is going through a correction, or you can say a very good growth stage in terms of stock market because of general perception. So there can be different factors, but the main factor is demand and supply of that particular share. And along with that, economically also, it benefits a lot for the economy. Right. Now, when I own a share, when I own a company share, what does that mean? Right. Now, for an example, let's say a company has 1 million shares issued, right? And I own 1,000 shares. So in other words, I own 0.1% of that company. I am a owner of that particular company for 0.1%. So 0.1% is considered to be very small. So therefore, I won't be able to make a major impact. Other than that, a person who is holding a larger portion of shares, they will be able to make a major impact in that company. Likewise, when I hold shares, and if the company decides to give dividends, that is the profits which the company has made, and the management will decide out of the total profit, we are going to distribute a percentage, which is known as dividend. So every shareholder who owns the share on that particular day is entitled for the dividends as well. Then there is something called voting rights. A shareholder is entitled for a vote. That means when they call for an annual general meeting, then extraordinary general meeting or some other special meetings, you can go and cast your vote. So usually I may hold one share. I have one vote. Another person might hold 100,000 shares. Again, if it's a hand raise event where they expect someone to be physically present and raise his hand and show his vote, irrespective of holding one share or 100,000 share, the vote will be one. But we know generally people who hold high number of shares, tend to have an impact, or they have a better say in the company. So as mentioned in the point number 4, a person holding a higher percentage of ownership will navigate the company, or he will run the company through the directors and managers. So directors, and again, there are legal consequences as well if you're holding a directorship based on exclusive director, or actively involved in the management or not. SEC and the CSC has given clear guidelines, your responsibility and their levels. Right. If you see the stock exchange, uh, by definition, it's a ownership of a unit of the company, irrespective of small or big. When you own a share, you become a owner. Then there are basically two types of shares. There are several types of shares, but we'll discuss two types here: common and preferred shares. Common shares is you have a voting right, you're entitled for dividends, and as and when dividends are disclosed, you will get. If dividends are not disclosed, you won't get. Disclose or declare, sorry. Preferred shares, more or less, it is very similar to a fixed deposit. You own a number of shares, but more or less your profit rate or the return rate is clearly mentioned. So Islamically, owning preferred shares, there are issues. So it is not considered as permissible to own preferred shares in Islamic financial institution, in any company. So therefore, owning preferred shares is a questionable thing, and it's not permissible. Then all these shares are operated through a stock exchange. Sri Lanka has Colombo Stock Exchange. The next slide, I think I will take you through a few details of the Colombo Stock Exchange. So now US has two stock exchange. It has the Nasdaq and the New York Stock Exchange. I think India also has two. So some countries, sophisticated countries may have more than one stock exchange. And Sri Lanka has only one stock exchange, that is Colombo Stock Exchange. So all the shares which are traded, or which is known as publicly quoted, will be listed in the Colombo Stock Exchange. So in the secondary market, people can buy and sell. So when the share movement, the activity is high. For example, today the stock exchange saw turnover for more than 6 billion rupees. So when activities are high, the ASPI, that is all share price index, tend to move. All share price index is it overall gives you a picture of the share movement based on the market capitalization, that is the price into number of shares on a weighted manner. They do a certain calculation and show how the performance of the shares and how people have been interested in buying and selling shares and the activities. So what does happen? Initially, let's say a company, they are into manufacturing, right? They thought, okay, rather now we have been working for the last 10, 15 years or 20 years in the market. So let us sell a portion of our ownership. Let us sell a portion of our ownership and raise some money. So this selling of ownership is known as issuing of stock, or issuing shares, right? So when the company issues shares, that means out of their total ownership, they tend to sell to the public. So when the shares are issued, right, against this share, they receive money. This IPO is mentioned as initial public offering, right? So when shares are sold, people will come and people will subscribe for these shares, and they become the new owners of the share. Excuse me. Can you excuse me for a minute, please? Okay. So when a company receives money, okay, against initial public offering, right? So the company has received money. In the meantime, they have diluted or sold the ownership to the public. Now, earlier the company was holding 100%. The initial owners were holding 100% of the company. Now they have decided 20, 30, 40, 50% to the public. So they hold a lesser percentage compared to their earlier holding. And the public is now holding a the percentage which they sold to the public. So against their shares, they have received money. Now this process is known as initial public offering. And the funds, what they use, generally they say when they sell the shares, what are they going to do with the funds, which the proceeds of this IPO, which is known as initial public offering. So those funds will be used to reinvest. Sometimes owners might take a share of that, but almost always they will reinvest and expand the business. And this process will make the value of the company much greater than it used to be. And now the share price will reflect in a better manner. So the people who bought, let's say the people bought a share at 10 rupees. So after the reinvestment and the expansion of the business, and after the business has come to the market and people are now, people are reacting on the activities of the business. Now the share value tends to move further, and therefore the people who bought at IPO can sell the share at a higher price and make money out of that. We initially know there are a few IPOs which came. One of the IPOs which I think, just to give an example, uh, Picme was such a case. I think it came at 30, 36 levels. And now it has even passed 50, 60. It's going at a pace. So IPOs can do well. So people who bought at initial level can make money after selling the shares. It can take us a shorter period. It might be for a long period. So to just take you through the history of the Sri Lankan stock market, the share market or the stock market operation started during the British period, that is 1896, under Colombo Share Broker Association. So in 1990, it was renamed as Colombo Stock Exchange, that is CSC, better known. Currently, there are 28 registered brokers firms, out of which 15 are considered as member firms and 13 are considered as trading members. So the CSC is owned by the 15-member firm, right? And directors, I think there are around 9 directors will be appointed. Out of that, I think around 5 will be appointed through the member firms, and the 4 will be appointed through government appointment. Currently, as at October 24th, 284 companies are listed in the Colombo Stock Exchange. As at yesterday's market capitalization, it is CSC is considered to be 5.2 trillion in terms of overall market capitalization, the value of the 284 companies listed on CSC. Okay, why do we need to invest into the stock market? Stock market is something, they say equity market or stock market will almost always outperform the debt market in the long term. Equity market will almost always outperform the debt market in long term. So, currently we are not running down the debt market or the returns. Currently, we are getting 7%, 8%, 10%. Even at the height of the crisis, there were companies who were paying 30%, but it was per annum. But sometimes if you choose a proper stock, if you wait for a period, making 30% is nothing for a company. We know within the last, if you see last 2 to 3 months, there are companies who have made 100%, 200%, 20, 30% has become very normal for most of the companies. So if a proper investment decision is made, right, making a reasonable investment almost always, which will be better than the debt market, if you see when it comes to performance. Likewise, now if you see the Expo Lanka story, we know Expo Lanka was a freight forwarding company which was listed in early 2000, sorry, after 2010 or 2011. What happened during the Corona period, pandemic, the prices came down. It came below 3 rupees. The share, which was, I think, listed at 14 rupees at that time, came below 3 rupees. Suddenly, the economic dynamics of freight forwarding changed. They became one of the few freight forwarders who were dominating the Sri Lankan market. Likewise, due to their international presence, they were doing well in the what do you call, Europe and American region. So based on that, a company, the share price, which was below 3 rupees, end up going up to 400 rupees. Yes, definitely there were certain pumps and dumps as well, but there was more or less it was demand and supply, feel good, sort of a duopoly or a monopoly situation Expo Lanka was having during that situation. But again, the share came down. If I'm not mistaken, it almost hit 100 rupees, 99 or 100 rupees. again at 185 rupees, the owners decided to exit Expo Lanka and buy out all the shares which was in the market. So people who bought at a low price, they made very good money. And in the meantime, people who bought at the high, above 350, 400 rupees, it was a unfortunate situation for them. So definitely there is high returns, but there are many guidelines and many limitations which we need to look into when we go into invest. Then the one more thing is, we have now, when we invest into stock market, usually what happens, we put money and it keeps on increasing. We compound. Rather than taking the funds out, it's better always to maintain and look into a long-term investment. Usually they say equity market is not short-term. We are not looking at 2 to 3 months, 3 to 6 months. It's almost medium or long-term. The money which you need for the next month expenses or your son's tuition fee in 2 or 3 months should not be invested here. Money which you are ready to lose in a crisis situation can be taken as a risk. But again, with a diversified portfolio, that's a third component. That means rather putting all the investment into one category, it can be one industry, one certain type of business. We can diversify different types. There are plantation, there are manufacturing companies, right? There are service-based companies. So based on different criterias, diversified. So overall, to a diversified portfolio in medium and long term, almost always the equity market will do much better than the debt market. So before we invest, it's very important to see what are my short-term and long-term goals. And one more, it's very important. Sometimes we need to have something called self-discipline. For an example, I should set a goal. Okay, within next 6 months, if I make a 20% return for a share investment, irrespective of how famous, how good you feel about that share, it's better to exit from that share. Some people have a very strong discipline. Once they make their internal goal, short-term pricing and long-term pricing, and within that pricing, if they make their money, they exit rather holding to the, because sometimes we have this love for that particular share. We want to hold, we want to raise, and always it says hold further. It might increase. But rather than doing that, it's investor, the experts say you should have a reasonable return. Once you receive that, you should know to diversify and look into other options as well. Then we should have the risk tolerance. Sometimes things can go well, and there can be things can go south as well. So that risk tolerance has to be there, because the prices come down. We are not going to sell everything and exit. So there should be certain level of risk tolerance. Then very important thing is we should educate ourselves, read and be updated. We should know what are the terminologies, how it works, the basic guidelines before blindly investing. And the most important thing as a Muslim investor, the most important things what we need to know is the Sharia guidelines of investing, which we'll be discussing in the coming in the slides. And we can choose a broker, and we can ask for information, ask for research and other materials. There are several brokers who can assist in this regard. Okay, Sharia principles of share trading. Right. When it comes to Sharia principle, right, as I said, holding a share means you become an owner of a particular share. You become a owner of a particular share. That means anything to do with that company, business, you're responsible, Islamically as well as legally up to certain extent. Now, it is a partnership arrangement between several shareholders on a particular share. Even though there can be 1 million shareholders, number of shareholders can be 1 million, or it can be, okay, for a better example, let's say there are 5,000 shareholders. But it's Islamically, when you look into that, it's a partnership of having 5,000 shareholders are there in a partnership. That's what we are talking about. So each partner is responsible for the actions taken collectively, right? Often, but practically what happens, minority shareholders may not be able to get involved in the management decisions. We know management can make certain decisions, get into new businesses, get into new activities. So as a shareholder, you're responsible, but because you're a minority shareholder, you won't be able to make an impact on the company. So, but it is advised that when you get a chance to get into the AGM, if you have Sharia concern, you have to raise and say, I have these concerns, better don't do this, because you're a shareholder. You have the right to raise and show your displeasure if there are Sharia non-compliant activities taking place. Let me take you through this example. Now, for an example, there's a business, right? A, B, and C, three partners get into and they start a business. It's a restaurant business. A and B are holding most of the shareholding, where they hold 40% each of the business. C is a silent partner. He doesn't get into day-to-day activities, right? He comes, he knows what's happening, and when the profits are divided, he gets his reasonable profit for his share. But he's not actively involved, but he knows the restaurant is doing well. It's a halal restaurant. Now, what happens because of the what you say, because there is high demand for this restaurant, people are coming. There are requests coming in from high net worth customers or event organizers. If you can also supply liquor in our events, so A and B decides, okay, liquor, we don't often get such orders, as and when we get such orders, why don't we supply? So because it's going to be a very small amount, if we don't, sometimes we may tend to lose a portion of the business which we can get from these customers who are requesting the supply of liquor. So because of that, now A and B gets into supplying liquor for their events as well, which means from the liquor sales, they will be getting a profit, even though it's a small amount, but there is a profit involved. Now, keep this example in mind. So this is a basic example I gave you of a general business activity of three partners doing a business. One partner is not actively involved, but he is also a partner, and other two partners are actively involved, and they have made a management decision also to do an un-Islamic or an activity which is not acceptable in Islam. So now, as a shareholder, as a minority shareholder, see what's his position. So most of the investors in the CSE as a Muslim investor or Sharia concerned investor will be in this position. So most of us will be in such a way we won't be able to make an impact to the company, right? But we are responsible up to certain level. So where are we going to draw the lines? What we can do and what we cannot do. That's what we'll be discussing in detail. Okay. If you see Sharia compliant investments option as a Muslim, right? We have Islamic fixed deposits, right? When we have short term and long term deposits, we have gold, precious metals, gems. There's nothing wrong in investing in any of these. Investing in real estate, no issues. Share investments and others. Others means it can be a one-to-one business, buying and selling. It can be a partnership, any business, even let's say in local market, PETA market, partners are there who buy, sell, who import. So if there are none, if there are no un-Islamic components in the business, such business is considered to be halal. Because in Islam, there's a legal maxim, right? It's a ruling which says, Al-aslu fil ashya'i al-ibaha, that is the original rule of all commercial dealing is permissible. So Islamically, doing a commercial dealing is permissible. There is nothing wrong. But there are conditions and there are guidelines which needs to be followed. So can I buy and sell? Yes. Can I manufacture? Yes. Can I provide a service? Yes. But certain conditions needs to be followed. Number one, all explicitly prohibited activities should be avoided. That means we know certain, for an example, buying and selling liquor is clearly prohibited. So indulging in what do you call pork related activities or haram meat is not possible. Then adult entertainment is what do you call is impermissible. So all explicitly prohibited activities in Islam, you are not get involved into such business directly. Number two, when it comes to dealings, we have to make sure interest is not there. There's no involvement of interest. Then there's something called gharar, uncertainty. Any business which is uncertain, where it's done in a shadow manner, it's not allowed. Then any business which allows gambling or games of chances, where the final outcome is not known, that is also not allowed. Again, as a Muslim, when you do businesses cannot get involved. You cannot cheat, you cannot lie, right? You can't unduly increase your price, and or you can't unduly condemn someone else's product. So there are certain business ethics which needs to be followed. Other than that, all in general businesses are halal, but these conditions needs to be clearly followed, right? So if you take the overall picture, we will have three types of businesses. One is clearly halal. There's no doubt about that. The business activity is halal. all the method, the way they are doing the conduct, everything is halal. So there's no doubt about that. For an example, someone is getting into real estate. He's buying properties and selling properties. There is nothing wrong. Another person is getting into plantation, right? He has bought several acres of land. He's he has used manpower. He's seeding them. Then after that, he's getting the harvest, selling them. So there is nothing wrong in that. Then there are activities which are clearly haram. That is, we know liquor is clearly haram, pork related meat is clearly haram, adult entertainment is haram, selling cigarette is haram, right? And getting directly involved in finance activities, which is interest is involved. That means the business itself. That means conventional finance companies, conventional insurance companies. These are clearly haram. So halal is clear. Haram is also clear. Then there are the third type of activity where the business is halal, right? The business is halal, but some of its components, not the core business, some of its components, some of their activities, how do they deal, has a impermissible component. So when you have a business which is halal, that is permissible, but having certain impermissible activities, certain impermissible non-Sharia compliant activities in such business, how are we supposed to deal with those? Now, so we don't have clear guidelines. Quran has not clearly said what to do, right? So Sharia scholars looking at, as I told you, looking at the current market situation, looking at why it's very important that Muslims have to grow their wealth and encouragement of wealth, and it's considered to be as a need of an hour. So they have given certain guidelines of how to be dealt in terms where the business and the most of the activities are halal and some haram or impermissible components are there in the business, right? These are 4 or 5 international organizations which have specifically given guidelines in such screening methodology or conditions in terms of financial conditions and other conditions. AOFI, which is a Bahrain-based international organization. AOFI has members from several senior Sharia scholars from several countries. So they have passed more than nearly 60 Sharia standards on dealings and how the banks, how the shares needs to be traded, and many activities. They have passed international guidelines how this needs to be uh, conducted, and dealing in share is considered as one of their standard. I think if I'm not mistaken, Sharia standard number 21, shares and bonds. Then Mizan, it's a bank and they have their group of companies. Mizan also have, and they are very active in the Karachi Stock Exchange in Pakistan. They have the senior scholars in Pakistan have given guidelines based on Pakistan and other requirements. So that is also considered as an international standard. Then the Security Commission Malaysia, it's a regulative authority in Malaysia. They also have given guidelines on how to screen shares. Then Dow Jones, we know it's an international index, dominantly used in US and other countries, European countries. FTSE Russell again, dominantly used in UK. Then our neighboring country, India, has BSE and NSE Nifty stock market. They also have given guidelines. So these are international guidelines given all over the world. So different guidelines, people can follow any of these guidelines when you screen a share. This screening is known as the whitelist. Whitelist is a screening methodology used by different countries. So there is nothing holding you are supposed to only follow this or that. Anyone can hold any of the follow any of these whitelists. But in Sri Lanka, in 2000 and in September last September 2024, Securities and Exchange Commission of Sri Lanka published clear guidelines with the consultation of senior Islamic finance scholars in Sri Lanka. They gave clear guidelines on what are the Sharia screening methods or criteria which needs to be used for the Sri Lankan market. So whitelist is a what do you call screening methodology, and Sri Lanka has Securities and Exchange Commission as Sri Lanka has given guidelines on how that needs to be followed if someone is going to prepare and publish the whitelist for the Sri Lankan market. So when it comes to screening, as I told you earlier, there'll be two types of screening. Sharia screening comes under one is known as the qualitative screening. Qualitative screening is the first step every company has to go through and have to get through, not go through, have to get through this. That is the core business. That means the company's core business or core business activity has to be halal. So when you say the core business activity, uh, usually the company in their vision and mission, and they will mention what are their core business activities and what are their short term long term goals. So they will clearly mention this is what we are looking into. So if the core business activity is not halal, is not considered to be what do you call is not permissible, then we won't have a quantitative screening. So any company which doesn't pass the qualitative screening, then that company is considered to be out of the whitelist. Once a company gets through the qualitative screening, right, and pass the core business activity, then we have the quantitative screening, that is the numbers which are given by the international the Sharia scholars. This is known as financial quantitative screening is basically 100% based on financial numbers of quarterly or semi-annual or annual reports, or any available information uh, available for that period. Right. Now, qualitative screening, when it comes to qualitative screening, the first thing what we see uh, is if the business of the company is into the core business is riba, that is, let's say, conventional banking, right? Borrowing and lending on interest. So such businesses will not be considered under whitelist. Then gaming and gambling, right? They won't be considered. Manufacture of or sale of non-halal product or related product. This is mostly meat related products. Then entertainment activities which are not permissible in Sharia. Then sale of tobacco or base product and liquor also comes into this. Then conventional insurance, arms and ammunition, stock brokering, and non-compliant securities, which clearly majority of the income is coming from interest or haram-based impermissible activities. All these businesses or any business which has one of these as their core business, as their main business, will not be considered as halal or will not be considered as permissible. So if we have any of a business having any of this as their core business or main business, so this qualitative screening, that company will go out of the qualitative screening, so there won't be any requirement of doing a quantitative screening after that. However, if the main business is not one of these and main business is a Islamically accepted or Sharia compliant business, then we will go for the next level of screening, which is known as quantitative screening. So Sharia scholars have spelled out or given guidelines on four types of financial ratios. We look into the income of the company, right? Then we look what are the types of investments the company is making or has made, and how much debt or the interest-based borrowings they have made, and liquidity, the cash position of the company. Right. Now, first criteria, which is known as the impermissible income, right? Out of the total income, what they say is out of the total income, right? If the impermissible income, out of the total income, if the total impermissible income is less than 5%, if the total impermissible income, sorry, this has to be less than 5%, right? If this amount is less than 5%, then you're allowed to invest into the company. Okay. Now, why 5% and why you are allowed? What they say is, if you see overall, we are living in a international, we are living in an arena where investments are made and interest has become part and partial of all our activities, right? So sometimes you have to deposit. For an example, even if you open certain, even if you get into certain Islamic products, sometimes by law you have to go and deposit certain amounts, right? Certain licenses are required. Likewise, sometimes your business dealing is such, uh, interest is involved up to certain extent. So you're not encouraging interest at all, but you're tolerating up to 5%. Now, 5% in general sense, it is considered to be something which is negligible or tolerable. You can't say negligible, it's tolerable. Now, when you do research, you call something as chances of error. What are the chances? The research figure or something up to 5% here and there, we say it's tolerable. So therefore, this 5% is given as a tolerable with certain condition of purification. I will also discuss that. So what are the types of income which is considered as impermissible is interest income is considered impermissible. Then dividends which are which you yield from impermissible sources are also considered as impermissible. Then conventional insurance related income or any other impermissible categories, this money came from some entertainment activities, this money came from certain liquor sales, right? So therefore, such amount will be considered as impermissible. But one more thing, after getting now, when the calculations are done, we know this company has impermissible income less than 4%. That means out of the total income, there is a 4% impermissible income. Now, for this 4% needs to be purified, right? There is something called purification, which we'll do in the coming slides. So even though you're tolerating something below 5%, from your side, you have to purify that as well. So Islamically, you're not just tolerating and saying it's, yeah, yes, you're okay about that. No, because that income is part of it's coming into the business. It's coming into the activity or the business where you're a partner. So you will get directly or indirectly are going to benefit from that impermissible income. So therefore, you have to, what do you call, purify such amount which you have earned through impermissible sources. So the second activity is interest-based debt. We know generally most of the companies are not managed by Muslims, so they will have borrowings, right? So when it comes to borrowings, there is no hard and fast rule on them. You have to go and have Islamic facility. They will borrow on Islamic, on un-Islamic, whatever is more available and easily available, and it depends on the what do you call relationship between the company and the bank. So there can be interest-based borrowings. So interest-based borrowing can be short-term, long-term loans. There can be OD facilities. There can be derivatives. It can be preferred shares. It can be finance lease, or sometimes it can be government-based leases as well, long-term lease based on plantation companies do have, right? So the all types of interest-based debt or loans borrowed by the company, which is if that amount is divided by the total assets of the company. If that amount is divided by the total assets of the company or market capitalization. Market capitalization is price into number of shares. So a company can be valued by their assets or by market capitalization. So either one of those, whichever is higher. So the Sharia scholars have given a chance whichever higher, but that value has to be 33%. Now, one thing we need to understand, when you borrow from a bank, borrowing from a bank is not haram. Borrowing from a bank is not impermissible. But when you repay the loan, you're paying additional interest. That is only the impermissible fact. So that's why they said anything one third is considered to be major in Islam, right? Anything or one third is generally considered to be as a major component. So therefore they say if you have a interest bearing loan, so interest bearing loan is not impermissible, but the interest component which you are paying is only definitely is impermissible. So you can borrow up to certain extent, but it has to be less than 33. That means one third or less than that is tolerable in terms of debt screening or impermissible borrowings. The third category is impermissible investment. Now, there are certain companies, they can be cash rich, they can be investment companies. Investments are investing into different activities. So when their investment activity, right, if the investment activity is impermissible, and such component can be has to be less than 33% or less than one third. So investment activity can be short-term, long-term deposits in a conventional bank, conventional money market instruments, T-bills, commercial papers, derivatives, or any other impermissible investment what the company has made has to be less than 33%. If you see the annual reports or the quarterly reports, they would have clearly given, especially the annual reports would have will clearly give what are the activities and where they have invested, and if it's they have made deposits into banks, what are the values, long term, short term. If they have bought treasury bills or bonds, they have gone into preferred shares. Usually the annual report carries this information. Then liquidity screening. Now the first three criteria is all about before you invest, we have to see what is it permissible or not. Now, this criteria is known as liquidity screening, or it's known as a what do you call a secondary market criteria when you buy and sell the share. Now, in Islam, we know cash is considered to be the ruling on cash is it has to be equal. For an example, if I give a loan of 100 rupees, even though that person is going to pay that 100 rupees after 2 months' time, I can only receive 100 rupees. So cash is considered to be equal. If the cash, the type of cash, or if the currency is different, for an example, dollar to rupee, we know 300 rupees will equal to, in Sri Lankan context, 300 rupees equals $1. So if it's a different type of cash, then it can be different value. Other than that, cash to cash has to be equal. So under this criteria, there are certain companies, even though and actually the value of these companies runs into billions, and they are so cash rich. Sometimes the cash component what they have is more than 70%. 70, that means most, if you see the value of the share, if you go into their, what do you call, balance sheet, the liquid form of their cash, that is cash and cash equivalent, short-term deposits, receivables, tax receivables, small things which you know you're going to get, you can convert into cash very easily. If that component is more than 70%, such companies we are supposed to deal on par, that is on the value of the company. But we know the company's value doesn't, the value is not based on the asset of the company, but it depends on the demand and the price of the company. The share price, what you are going to pay in the market, depends on demand and supply. So before investing, we have to see if this company has a larger portion in terms of liquid asset. For example, I have given you all two examples. Now, this company, the first one, overall, the company has 250 million in total assets. Long-term assets, they have 150 million, and the current or liquid assets 100 million. So if you see the liquid asset to total asset ratio, it is only 40%. The second one, out of 250 million, 200 million are in terms of cash. That means if you actually buy a share, you're not buying real assets, you're buying cash equivalent assets. So Islamically, a cash equivalent asset cannot be traded above the value because it is equal to cash. Therefore, the Sharia scholars have said, okay, it's not practical to go 50-50%. So up to 70% they have allowed, you can have a liquid form. But if it is more than 70%, you're not supposed to buy that share because you will be dealing very equal to cash, which is not allowed to be dealt other than par. So these are the four criterias which gets mainly involved in terms of whitelist. Just to again recap, that is the income, impermissible income, which has to be less than 5%. Investments, impermissible, can be less than 3%. Impermissible debt or Sharia non-compliant debt or borrowings has to be less than 33%. And liquidity, that is a liquid asset, has to be less than 70% of the total assets of the company. Right. Now, this almost the same news was shared in in the previous. Now, if you see the overall, the way we are going to look at in this. Now, this news item, Sri Lanka's JK signs up international gaming operator. Now, John Keels is a conglomerate, one of the biggest companies, old company, right? Now, recently they signed up with, again, this news item, again, City of Dreams of Sri Lanka Hotel opens casino. That means a company has now has gone and signed up with a casino company. When this news comes, then as a person who is looking into the whitelist should know, that means there is an impermissible component which is going to get added throughout. You now explicitly know. Now, certain activities we don't know. If we don't know, then we are not responsible for that as well. We have to look into as much as possible to know these information. But if you generally don't know, you're not responsible. But once you come to know that there is some activities of this taking place, then it triggers, and we have, when the next whitelist calculation is being done, this needs to be taken into consideration, how much money, how much income is going to come from this. Now, one of the issues or practical issues in screening a hotel is sometimes the hotel, see, the main activity of a hotel is not haram. It's not impermissible. Activities, they're actually renting out their space. Two bed, three bed, they are renting out. That's their main activity. Along with that, they will have functions. they will have maybe nightclub or entertainment related activities. Along with that, they will have liquor sales. Along with that, they will have pork or non-halal meat sale. So this pork or non-halal meat sale, liquor sale, the income received from liquor sale, if there are entertainment or activities or nightclub related activities impermissible, how much? Since we don't know this component, there are certain companies which we are unable to quantify, and we are unable to see what is the value of those companies. So such companies will not be screened because the information are not available. Right. Now, as I told you, in criteria number one, we said the impermissible income, even though we tolerate up to 5% or below, we have to purify. Purification, there are two views, two methods. One is known as a dividend model. Second one is known as a capital gain model. Dividend model means we know certain companies, they pay dividend, right? They say on every share we'll pay you 1 rupee, 2 rupee, 5 rupee, 50 cents, right? Now, the company, if we know the company is impermissible income is less than 5%. Let's say the company's impermissible income is 4%. And if I get a dividend of 1 rupee per share and I'm having 10,000 rupees, now out of this 10,000 rupees, I have to make a calculation of 4% and give that 4% on charity, because I know in my dividend there is an impermissible income percentage of 4%, because that calculation was done. So that in dividend model, the impermissible income percentage will be multiplied by the dividend received. Impermissible income percentage definitely has to be below 5%. Then only it will qualify into the whitelist. So once it qualifies and still you know there is an impermissible income, that needs to be purified by multiplying into the dividend total amount what we have received. Then there are some other scholars say no, it's not sufficient to do only on the dividend model. You have to go on the capital gain model, because there are companies who don't pay dividend as practice. They only pay dividend, or mostly they don't pay dividend. So what they do is they keep on growing the company. So if you don't receive the dividend stream, does that mean you're not going to purify at all? So what they say is on we know what is the impermissible income portion we have in that company. Let's say the company has around 5 million rupees impermissible income for that quarter. Now that company has 10 million shares issued. If there are 5 million in terms of value of impermissible income and 10 million shares issued, 5 million divided by 10 million means on every share there is a 50 cents impermissible income. On every share there will be a impermissible income per share, that is 50 cents. So if you know there is 50 cents on impermissible income on every share, and how many shares did I hold for that period, I can multiply and give that on charity. So based on dividend model or capital gain model on a quarterly, biannual or annual basis, the people who are holding shares are supposed to purify their share portfolio. Then there are a few common practices or impermissible activities which usually take place in stock brokering, that is broker credit. Usually in Sri Lanka, maybe there is Almas, where actually I serve. There is a Islamic broker facility. Other than that, I don't know any other companies offering Islamic broker credit. So broker credit, usually they give you a loan to buy shares, and within 4, 5, 10 days, 15 days, you have to settle. So for that loan, they will charge interest. So that is 100% out. It's not permissible in Sharia. Then there is something called margin trading. Again, very similar to broker credit, but usually margin trading takes place for a longer term, for a longer period when the markets are active. People who have shares, they pledge the shares under the margin provider, whoever is ready to give financing, and the margin provider will give a loan to buy shares again, and all the shares will be held by the margin the financier as security. So such activities are also I don't know currently anyone providing Islamic margin trading. Maybe Islamic financial institutions are providing, maybe. If it is not provided through Islamic financial institutions or structured through Islamic financial institution, even margin trading is not considered to be halal. It's clearly haram. Then short selling. Short selling is you borrow a share. You don't buy a share. You borrow a share and expect the prices to come down, and you agree to sell, provide the same share, or again get him the same share after a certain period. Against this borrowing, there is a price which you need to pay, that is again interest. Again, short selling also technically, because the share value can change and it's a loan agreement, that is also not permissible in Islamic financial concept. So broker credit, margin trading, and short selling, which are commonly practiced in short selling, everyone don't do, but broker credit and margin trading, there are many people who practice. But if you don't find Islamic solution, it is not permissible to practice any of these activities. So this is Ummat. Uh, we do consultancy on overall this financial training, compliance audit, dispute resolution, financial product structuring, document review, and investments. If you have any questions or anything related to today's lecture or any of these, inshallah, you can contact Ummat and you can contact them, inshallah. Jazakallah khair for your time. If you have any questions, maybe we can entertain one or two questions. Other than that, we should be able to close the lecture. Since there are, I don't see any questions coming in. So if you have anything, you can write directly to Ummat, and there are a few on the chat. Someone has asked, what is debt market? A debt market is uh, investments which are, sorry, debt market is when you borrow from the banks, anything borrowing or deposits or whatever the returns you get from the bank is considered as debt market. I think they will upload this on YouTube as well. On a later date, inshallah, you should be able to get access to this, inshallah. Arms and ammunition is not considered as halal because we don't know. See, arms and ammunition we don't use for, generally, it's not being used for other than security purposes. It won't be used for something good, right? Maybe yes, to as for the security officers for in a country, yes. Other than that, generally it won't be used. So therefore, generally arms and ammunition is not encouraged. When meat manufacturing company is not halal, then what happens is that amount, if you don't know what's the income generated through that activities, now we have certain companies in Sri Lanka as well. We don't know the values and they don't publicly give the value saying how much came from halal certified and how much coming from non-halal. So therefore, it's difficult to screen those companies. So we might need to skip. Someone has asked, uh, to again sum up on the purification. Now, purification is done on two methods, right? One is the dividend model and one is the capital gain model. Dividend model is on the dividend income what you receive that needs to be multiplied by the impermissible income percentage. Now, impermissible income percentage, people who do the whitelist, they will know when a company is definitely these companies has to be in the whitelist. Then only it will be less than 5%, but still they will have impermissible component. So if it is, it can be 2, 3%, 5%, 4.9% also tolerable. So let's say the impermissible income of that company was 4%, and the dividend, this person has received 10,000 rupees as dividend. So out of the 10,000 rupees, 4% needs to be paid as charity and purified. The second model is capital gain model. That means there are companies who don't pay dividend. So it doesn't mean because you don't pay dividend, you don't need to purify. So every company you can find every quarter or every annual, what is the impermissible income of that company. So let's say a company has 10 million rupees as impermissible income. Now this company has 1 million shares. Let's say 1 million shares have been issued. So 10 million, that means if you divide 10 million by 1 million, you will get impermissible income per share. For every share, how much impermissible income this company is holding. They have 10 million rupees as impermissible income and the company has 1 million shares issued. So every shareholder is getting 10 rupees as impermissible income. So 10 rupees into 1 million is 10 million. So as a shareholder, if I am holding 1,000 shares and I know 10 rupees is the impermissible component, 1,000 into 10, 10,000 rupees needs to be given as purification and given as charity. Hope I have answered most of your questions. It depends. Now, some people have asked, even if dividend model is applied, capital gains model when you uh, when you hold it or when you sell it, you need to. So you can use one of those. And if you wait until the next financial quarter, and if you know this is the capital gain amount you have made it, then you might need to. So other than that, you can follow one of these. So some of the ulamas or most of them, AOFI prefers the capital gain model, and some of the Malaysia and some other countries are practicing the dividend purification model. Then again, there's a question, someone buys a share during whitelist and it crosses, and when you sell it, or by the time you're still holding and it has gone out of the whitelist, better to get a Sharia scholarly opinion on that. But there are different views on that. If the investment is loss making, you can hold until you cover your investment. But if you know it has gone out of the whitelist, and if you don't want to hold, you can sell it as well. It's a matter of drawing the lines. It's each person's taqwa and piety level. LOLC, you need to double check because they also have some other finance. Most of their activities are finance based, so I doubt they might come into the whitelist. You need to double check anyways. Then zakat on the due date. How to pay zakat means on the due date, you have to see what is the value of your share, because there is a zakat payable date for every person, not necessarily first of Ramadan. For once your 1 year is completed on that due date, you have to see what is the share prices and what's the value of your portfolio. For the total portfolio, zakat needs to be paid. I hope we can close this session, inshallah. Jazakallah for attending. And if you have any questions, you can contact through the email and the contact number given. And Jazakallah khair. Assalamu alaikum warahmatullahi wabarakatuh.